Investments are crashing and people are losing their minds as they watch their invested money go down every week. Emotions are riding high, and when emotions ride high is when new investors make the worst mistakes. Today I'll be showing you how to protect your money by avoiding 3 critical mistakes when investing in a down bear market. So stick around because you're not going to want to miss this. What's up, everybody? This is Positive Finances, where we talk about everything and anything that has to do with you and your money. Many new investors are experiencing their very first down bear market, and I'm here to tell you to relax and ignore all the fear-creating noise you're constantly hearing about the market. Seasoned investors all know down markets are part of the process when you're investing for the long term. You need to stay focused on the long-term results and not focus on the short-term, emotionally driven ups and downs. Investors who have not yet learned to control their emotions when it comes to investing tend to panic as soon as they see any big drop in the stock market. One of the main things I've had to learn over the years is to set aside the emotions and only make investments based off of good, sound logic. In times like this, I like to remind myself about some advice from one of the most successful long-term investors, like Warren Buffett. All right, when he said, "Be fearful when others are greedy, and be greedy when others are fearful." With that said, let's go ahead and look at the 3 most common critical mistakes people want to avoid making during a down market. Number 1, selling off long-term investments. People sometimes hurry to sell their long-term assets as soon as they notice a significant declines in the stock market. The truth is that rather than liquidating your existing positions, you should probably aim to buy more of those long-term stocks. When you invest for the long term, it will take time for you to get a return on your investments. Therefore, what occurs today is less important than what occurs 7 to 10 years from now. One of your options in a bear market, if you have extra money, is to increase your long-term investments and buy more shares while the shares are low and on sale. By acquiring more shares, you're lowering your average value of your original shares, and this will help you recover that much faster as the market recovers. Let's just say you already own 50 shares of the S&P 500 by investing in VOO at $400 each, and the price of VOO drops to $330 each. By buying an additional 25 shares, you will lower your average value down to $376 per share. With your combined 75 shares, the market only has to go up to $376 a share for you to recover or break even on your investment. Anything higher than $376 is just pure profit after that. Now, some of you might be asking yourselves, why would I buy more shares if the market keeps going down? With that in mind, let's go to the second critical mistake. Believing that the market is always going to continue to decline. People that are scared and think the market is going to always decline don't comprehend how the market behaves over extended periods of time. Many people overreact to significant movements in the stock market. According to many reports, the S&P 500 has gone through 26 down bear markets since 1928. Each time the stock value decreased on average by almost 36%. Meanwhile, the up bull market saw stock prices rise an average of 114% during its up recovery. History has taught us that maintaining onto and perhaps increasing your long-term investments during down bear markets can be one of the most beneficial things you can possibly do during a bear market. During the recovering bull market, the stock market gains outnumber the stock market losses. So if the bull market does so much better than the down bear market, then why are so many people losing money left and right in the down markets? Well, that brings us to the third critical mistake. not knowing the difference between long-term and short-term investments. Experienced long-term investors do not get all caught up in short-term emotion. Time is on your side when it comes to investing as a long-term investor, as long as you are investing in some well-diverse index funds. The S&P 500, for example, and many other good index funds have all shown their ability to recover and set new records after previous bear markets we had in the past. Even after the drastic negative markets such as the dot-com bubble of 2000, the Great Recession caused by the real estate market crash of 2008, and the recent down market of COVID-19 pandemic in 2020. All historical data suggests that by making a long-term investment in the US stock indexes like SCHD, the Schwab Dividend Fund, VOO that tracks the S&P 500, and VTI that tracks all companies in the US will eventually end up with long-term positive gains. After hearing what I said, you are probably asking yourself, why are some people reporting they are losing money? Well, the primary reason for that is people are losing money because they are most likely playing around with short-term investments or individual stocks. Short-term investments, and especially short-term investing in individual stocks, can be extremely risky due to the stock market's volatility. Sometimes people think if they invest in a well-known company, they will not have to worry about daily ups and downs. Short-term investors try to time the market, and they tend to get in and out of their positions on a very regular basis. The stock market is so unpredictable. If you're constantly trying to time it by getting in and out, you're only going to cause yourself a headache and bring unnecessary stress into your life. You're going to end up risking the chances of accidentally buying high and selling low. As I previously mentioned, there is a good likelihood that your investments will be profitable if you hold it for long term. And by long term, I mean more than 7 years. Properly invested in a reliable index fund, the chances of losing money are substantially greater when investing for brief periods of time in individual businesses. Some investors can make some money doing these short-term investments into individual companies, but they open themselves to potentially losing big because of volatility of the market. Personally, I say short-term investing should only be for experienced investors that have learned to control their emotions and have a high tolerance for risk. They are going to need that high tolerance when it comes to being able to handle the drastic highs and lows the market can experience in the short term. In summary, the best way to beat the market is by becoming a long-term investor. It should be noted that stock market investing requires you to be ready to stomach the ups and downs. You should only take measured risk with short-term investments if you have the experience. Based off historical statistics, if you want to be secure with your investments, then you can't go wrong with long-term investments in good index funds like SCHD, VOO, and VTI. The longest bull market in history was from 2009 to 2020, and that bull market saw more than a 400% increase in stock prices. Now keep in mind that bull market was out of the norm because the typical bull market on average only lasts around 2.7 years, and the average bear market lasts around slightly under 10 months. I'm going to go ahead and add all the links you need in the description box below for some of the stocks I mentioned here, so feel free to go to the description box below and check out all the links to see any additional info I did not cover in this video. If you like this video, do me a favor and give this video a huge thumbs up. Make sure to subscribe to the channel and click on the notification bell to get notified every time I release a new video. If you want to visit my channel, you can click on this icon here to check out additional videos I have, or you can check out one of these two videos over here YouTube is recommending for you from my channel. And remember, as always, stay positive. Together we can do this.